You're listening to ALTLOOK, the Alternative Investments Podcast, a series from Kroll focused on key market, valuation, regulatory, compliance, and other nuances of alternative asset investing from various perspectives, including those of fund managers, general partners, investors, limited partners, regulators, and other interested parties. In our fourth episode, Kroll's David Larsen talks to Megan Greene, Kroll's global chief economist, about how alternative asset funds are taxed and the implications for investors if tax rates change.
Welcome. Today, I'm joined by Megan Greene. Megan joined us several months ago as Kroll's chief economist. Megan serves as a senior fellow at the Harvard Kennedy School. She's got a forthcoming book that she's working on drivers of inequality in developed economies and the policy and corporate remedies. We're very pleased that Megan has been with us for these past few months, and we're looking for a unique and ongoing collaboration. Megan recently participated in our 15th annual Alternative Investments Conference, virtual. If you were not able to participate in that this past November, please go to our website at kroll.com and take a listen to that replay. Megan, again, we're very pleased that you're with us today, and I'm looking forward to kind of a provocative discussion as we get into some of the maybe areas that some people think they know well about on the tax area in the context of alternative assets. We're in 2022 and we're moving forward. Congress has, let's say, been talking about and making changes to tax legislation, trying to get all of us to pay our fair share. We go through the reconciliation process. We've got all these things that I think most of us know about at one level, but at the same time, kind of our eyes glaze over when we think about, well, do we have a majority? Are they being able to pass legislation? Are they just talking about legislation? Does the reconciliation process work? How does that work? Kind of as we kind of jump into this, and I'm just launching right in, Megan, why don't you just kind of give us your thoughts on how that soup is made, or said differently, how the sausage is made in this context, and maybe a little bit how it then kind of flows into the alternative asset space.
Yeah, sure. So the Biden administration obviously has a really aggressive spending program, and in order to pay for it and not blow out the budget deficit and inflate our stock of debt, there are tax changes that will cover some of that. Now, for years, I feel like both political parties, depending on who's in power or not, have vowed to get rid of the carried interest rate. And so as the Biden administration was campaigning, that was one of their promises, that they would get rid of it altogether as a so-called tax loophole. And yet we've still got it. And I think that's thanks in part to the power of the business lobby with both parties. The Ways and Means Committee initially tabled a tax bill. And actually, there was very little changed in terms of carried interest in particular. The holding period was shifted from 3 to 5 years. Now, a lot of the sausage, as you point out, is sliced and diced in lots of different committees, but that was initially what was tabled. So, there's not a huge change there. Because of our budget process, we can go through reconciliation and push through big changes with a simple majority. And so the tax bill's been rolled into that alongside a lot of spending measures. So we're getting that all together. And once again, we don't need a supermajority. We just need a simple majority this time around, which has also been the case in the past tax bills. It's a much easier way to get tax reform through.
And we're talking a little bit, let's say, U.S.-centric when we're talking about some of the U.S. tax policy. Clearly, the alternative asset industry is a global industry. And there's been times as we've gone through, as I think back over the past 5 to 10 years, there's been various efforts to, again, look at offshore and how things progress. As I think about when you're doing something where, and again, we're focused on carried interest, and carried interest, it's not just carried interest per se. And again, by carried interest, it's kind of a funny term, and just to make sure everybody in the industry, I think, knows what it means, but some people wider means it's really the incentive compensation that a manager or an investor receives. And the key question, I guess, that is being dealt with is, should that be, let's say, ordinary income to whoever is earning it, or is that really a capital gain? Is it derived from the gains on investing capital? And again, the Biden administration seems to make a distinction that, or want to, and I don't know if it's driven by a true belief that this is the right way to do it, or if it's just really trying to, let's say, how do we pay for all the things that we want to spend money on? But that kind of, is there, let's say, merit if we take a step back? If we think about capital gains in the first place, we're going to take that step back to looking at the impact on the overall economy, should there be a separate kind of tax rate for invested capital? And I know that if we go back over the last 50, 100 years, there's been ups and downs, and there's been lots said about different tax rates on different types of income, capital or capital gains and the like. Are we trying to say now in today's world that we should walk away from that? Or is it, and I realize it's kind of politicized, but what insight do you have to shed on that, Megan?
Yeah, the argument that the Biden administration has had on this is that effectively you've got hedge fund managers paying lower taxes than Joe Sixpack, who's also, investing. And so that doesn't seem fair. The general partners investing their own money, but also money from limited partners, of course. And so the profits that they're getting are being taxed after a certain period as if it were all their own investment rather than as if it's an income. So, should hedge fund managers, private equity be paying less than regular people who are engaging in similar activities? And the Biden administration has argued no, though they've gone back on that in the face of lobbying. The other side of the argument is that actually, if you change this tax structure, it will change incentives for investment. And so fund managers will, knowing that they have been generating higher returns, will have to go out and engage in riskier investments in order to continue to generate those kinds of returns under a new tax structure where they have to pay more. And so that increases the risk, of course, as well. And that's a bad thing for public pension plans, for example. So that's the other side of the argument, that actually incentive structures would be shifted if you changed the tax structure and would incentivize riskier behavior with possibly lower returns.
And that's kind of an interesting perspective, because, again, the U.S. tax system is a little bit, I'll say, unique in that it tries to grab and tax whatever you earn wherever you earn in the world if you're a U.S. taxpayer. But if I'm let's say an investment manager, and I was born in the UK and I live in the UK, and I guess post Brexit, maybe I don't be able to move around as easily as I once did. But so maybe I take the example, I'm born in France. I grew up in France, and I say, all right, Luxembourg is going to give me a beneficial tax regime. Why don't I just go to Luxembourg and pay 10% tax or 10 or 20% tax? Why would I, let's say, avail myself to invest through any vehicles that touch the United States and pay 40 or 50 or 60% tax? It kind of doesn't make any sense. And it seems like if we go down that path, you're doing exactly what you kind of just said. You're either pushing people to take on more risk, or you're pushing this industry to be an offshore industry that doesn't touch the United States. Is that something that they focus on, or is that not something that, when you're really trying to say how much money can I raise, again, you see big numbers, but this kind of, well, people are going to react to this however it plays itself out. It seems like that never gets scored when the Congressional Budget Office scores these things to see how much revenue they're going to make. Is that kind of opportunity cost or implication?
Yeah, I think that successive administrations have been trying to close loopholes in terms of offshoring, and Secretary Yellen's attempt to generate a global minimum tax is certainly one way to try to achieve that. So I think it's a concern. It's something that both Republican and Democratic administrations have tried to address, but of course it's difficult. I would highlight, though, that according to the CBO's estimates for how much changing this tax structure, scrapping carried interest, would generate They did it back in 2018 and estimated that it would raise about $14 billion over 10 years, which is really a drop in the bucket. So that's pretty underwhelming. So you have to ask whether it's worth it. It doesn't look like it would generate that much in tax revenues. I have seen other estimates that are much higher, of course, and it's all dynamic scoring, so it depends entirely on what your inputs are. But according to the Congressional Budget Office and also the Joint Tax Committee, this wouldn't actually generate that much in terms of revenues.
So does that mean that this is really more politics than it is economics? As I kind of look at these things, I always try to be objective, I kind of look at myself along the way as a fact witness. What are the real facts here? When I'm dealing with valuation issues in private investments, again, tell me what's happening with the company. Tell me what people are doing, and then let's evaluate that, putting kind of a professional skepticism lens on it. So is this more political posturing than it is actual, let's solve the budget deficit?
Well, I think it's both, to be fair. As I mentioned, the Biden spending agenda is incredibly ambitious and marks a real sea change in policy thinking around fiscal stimulus, the role of policy, how to come out of a downturn, how to put your economy on a higher plane so that you can avoid scarring. So it's hard to overstate how ambitious the spending plan is. And so to pay for it, I do think the Biden administration is trying to figure out revenue streams everywhere they can. So even if this revenue stream, according to the Congressional Budget Office, wouldn't be big, it's something. And so I do think the Biden administration has kind of an all hands on deck, figure out where we can generate revenues wherever we can. So I think that's a piece of it. But to your question, whether it's also a political issue, I think it certainly is. I think at the heart of it is sort of equity and also efficiency. So there's a sense that everyone should be paying their fair share, but also that, you should be taxing managers or regular people the same amount for the same work that they're doing. So I think that's part of the ethos of the administration and underpins any proposals to change carried interest as well.
That kind of fair share question, it's always been I won't say a unique one, but it's an interesting one depending on how you look at it and how you think about it. Because I think, again, as you mentioned, should we be paying fair share based on an absolute percentage, which maybe argues for a flat tax, or should we be paying fair share based on the aggregate dollars that are paid? And that's kind of a very different view and way to think about it in that kind of overall context. I think maybe I just want to peel back the onion a little bit further because I want to probe on that kind of to say if we think about this whole taxation and alternative assets, and maybe I shouldn't go here, but let me give a little bit of background just to make sure that we're all on the same page, particularly our listeners. And I think most of our listeners understand the private equity industry, understand how everything's taxed, but I'll just, in case there's some that aren't, I'll just hit very, very quickly. If I take just as an example, a private equity fund that has a size of 100, and maybe that 95 of that $100 came from limited partners, public pension plans, sovereign wealth funds, high net wealth individuals, and the like. And you say, all right, that 100, and maybe even to simplify it, I'll say that there's no money that comes from the general partner. It's all from the limited partners, the 100. Well, they pay over the life of the fund, they pay fees. Let's say they pay 10 of fees. And the 100 gets invested, they pay 10 in fees, and then they end up receiving as proceeds, they actually sell the investment for 200. So there's 100 of profit. Well, that 200 that comes back, you first take the $10, you repay the $10. So all the fees get repaid. So that's kind of a one piece that sometimes we forget, at least in most structures, fees get repaid. So people say, well, this is a high cost industry. Well, but those fees do get repaid. So now I've got 190 left over. Well, then the limited partners get all their capital back. So that's the next $100. So now I've got $90 left over. And then in the agreement, most general agreements, the manager or the person making the investment decisions, they get 20% of that profit and the investor gets 80% of that profit. That's by agreement before anybody invests. I don't have to give my $100 if I don't want to agree to that kind of allocation of the profits. So that allocation of profits means that the manager got 18 of profits, 20% times the 90, and the investors, the limited partners, got 72 of the profits. So they get a 72 profit and the manager got 18. So the key question there, and I think that's what we already highlighted, is should that 18 be ordinary income, taxed at ordinary income rates, or could it be capital gains taxed at capital gains rates? But that's $18. And again, whether it's taxed at 20 or 25% or at 60%, that's a very big difference. But what we often miss, and maybe it's appropriate, but maybe from a public policy perspective, is much of that 72 gain that also is gain. And in the normal world, people would be saying, hey, that's huge profits. We need to tax that. If I'm a public pension plan, the tax rate I pay on that is zero. Is that something that makes sense from an overall economic position? Is that from a fairness position, from all those kinds of things? And I realize that maybe I'm touching a third rail, but I think just to kind of think about this in that kind of overall context, should we be treating the 72 gain the same way we're treating the 18 gain? Or should we be treating the other investors the same as we're treating the manager?
Yes, I think that's a deeply political question. And, you're basically asking if everyone should pay their fair share. And the easy answer to that is yes. But the harder piece of that is, what is the fair share? Should pension funds be paying less in taxes because they're essentially going to pay out people's pensions as they get older? And that's better for the economy. That's a deeply political question. Maybe they should be paying less. How much less is another question, though. And I think that economics doesn't underpin that. It's much more politics.
I think you're absolutely right. It is a political question. Part of the reason I raised it is just to kind of shine the light here, because I think as I look at this, it's really the unintended consequences, the how do people react to a different tax regime, and how will that impact behavior? As you mentioned at the beginning, does that change your risk profile? Do I have to now invest in riskier investments to be able to get the same, I'll say, cash flow if I'm a manager that I had before on an after-tax basis? And is that good from I'll say, a public policy perspective for a public pension plan? If I'm New York Common or I'm the CalPERS, California Public Employees Retirement System, today I've taken the posture to say that I don't owe any tax on that 72 gain, and I don't pay tax, and the IRS hasn't challenged them whether or not they pay tax. But if I take that step back from a kind of that public policy perspective and say, all right, if I'm a taxpayer in California, I probably want the CalPERS to make as much money as possible on a tax-free basis. Because if they have more money and more returns from their alternative asset investments, they have more money to pay their pensions, which they're contractually obligated to pay. And they don't have to come back to me as a California taxpayer, which I once was. I am no longer, full disclosure. I moved away from California several years ago. But as the California taxpayer, they effectively don't have to make up the difference, because the taxpayer is the one who makes up the difference between the pension that's obligated or the legislatures have agreed to pay their public employees and the amount of money that's available to it, which in part is driven by the amount that they're contributed, but is really coming from tax. Either it's coming from taxes on their citizens or it's coming from investment returns. So that's maybe slightly convoluted, but as I kind of take that to its full extension, the beneficiaries of a public pension plan, yes, it's the people getting the pension, but the person paying for that is the taxpayer. So shouldn't I really be focused on how do I accelerate gains in this industry, as opposed to trying to somehow tax them and change the return structure to possibly cause gains to or returns to diminish?
The difficult thing to parse out, I think, is how much the tax structure actually influences gains versus how much the holdings influence gains. I mean, the reason that pensions are investing in alternative assets is because on average their yields are much higher, but as with higher yields, you get higher risk. And so the data is really murky in terms of whether tax structure really incentivizes outcomes or whether it's actually just the holdings that the general partner had invested in. That's the difficulty in making the economic argument. It's also worth highlighting that if the biggest change really is the holding period from 3 to 5 years, on average, the holding period is already 6 years. So that's a fairly cosmetic change that shouldn't actually change incentives that much.
No, I think that's a very good point. And again, that's that kind of that 3 to 5 years. And is the 5 years, and I've again seen some of the proposals, so I apologize if I probably should have studied it more, but is that 5 years across the board, it's everybody gets capital gains, or is it still just those that capital gains are if your overall income is less than 400,000?
So I think it's if it's less than 400,000, and it also exempts real estate, importantly. So it's just really a shift in years, not in anything else.
And I think that that's also one of the things that if you kind of look at some of the alternative asset structures, there's other things that get caught up in it. There is, you mentioned real estate. There's sometimes family, also, for lack of a better word, family farms. There's a lot of other structures that kind of mirror the private equity or the venture capital or the alternative asset structure. And it's kind of an interesting way to try to write legislation that targets one type of entity where you've got another entity that is, let's say, virtually from a legal construct exactly the same, but it's just making its money differently. It's making its money from selling corn as opposed to investing in a new technology that benefits a lot of has the potential to be changing in the overall economy. I mean, we've seen that as in the past 10 years. We've seen that even during the pandemic, where they've got companies that kind of came and actually impact us significantly as consumer preferences change, as conditions change.
Yeah, that's right. I mean, there's one thing I will say, just in terms of concern about how tax structure might change incentives, but also returns, is that I never worry about the ability of private industry to get around tax code. And it might be a little bit more difficult if some of these so-called loopholes are tightened up, but I have every confidence that new ones will emerge. And so in terms of a structural shift across all of alternative assets, I'm not actually concerned that there will be such a big shift, because I think there will be other ways around it.
So we don't know how this is all going to shake out or how it's going to look. If we shine up our crystal ball and say, all right, we're in a world where the tax rate for carried interest, and if you layer in certain states, maybe New York, California, that goes up in excess of 60%, where today maybe it's in the 25 to 30%. So basically doubles. What does your crystal ball say, Megan? Does that have a minor impact on the alternative asset landscape and overall returns? Meaning, and I'm just saying, let's look at it from the perspective of that public pension plan that really does want to have those returns to pay the benefits for their beneficiaries. Does their return kind of stay the same? Does it go up? Does it go down? Is it way too soon to tell? But if you kind of just look at, let's say, past history where there's been significant tax increases, do the smart people just figure out a way around it? Or is it, and it's not going to impact the overall net returns? Or if I'm a public pension plan manager and today I'm expecting a net return from my private investments to be 10% plus, do I now have to say, no, it's going to be 5 to 10% rather than 10% plus because of what's going on? And I actually need to start asking my governments, my local governments, to start contributing more because my overall returns are going to be less. That's a kind of a multifaceted question. I'm probably went too far, but really, how do we see this playing itself out from the kind of return perspective, knowing that the taxes are going to be what the taxes are?
Yeah, look, that kind of jump is significant. So if we were to actually see that kind of jump, and I'm not expecting it really across the board, yes, some companies will figure out a way around it, certainly with different tax structures. Offshoring, as you suggest, might be one option as well. And that has implications for the U.S. economy, certainly. But for the returns, it wouldn't have that big an impact. Some won't. And so if, general partners are having to pay that much more in taxes, they might hike their fees to offset it, because every investment is going to be structured to benefit the general partner as opposed to the limited partners, certainly. In which case, the limited partners will have to pay more, and they can expect their returns to go down on average, though, of course, that could also drive general partners into riskier investments in order to try to generate even higher returns than they are now to offset the tax structure, in which case you might find some higher returns for limited partners, but on average, they should be lower, in which case, they'll have to make up the difference somehow, to your point. So you might end up having slightly higher taxes in order to fill that gap. But I think there are a lot of different options here and a lot of possible outcomes. The economics is not straightforward, but that's a huge jump that you're talking about, which I actually just don't see happening.
Got it. Well, Megan, I appreciate your taking the time to speak today. Some very good insights. Welcome you to come back. I know at a future podcast, especially as you make more progress on your book. One of the other pieces that we've talked just focused on taxes today, but as you kind of get into the realm of ESG and how does that play itself out in the context of returns, I think is also very interesting. And it seems like your book may be touching a little bit on that. So we very much are looking for your insights. We're glad that you've now been with Kroll and the Kroll Institute for several months now. We appreciate your participating with us and look forward to speaking with you more.
Yeah, thanks so much for having me.
So thank you all for listening today. Again, if you've got questions, please reach out. If you've got suggestions for future episodes, let us know. You can reach me, david.larsen, Larsen, @kroll.com or podcasts@kroll.com. Again, thank you and have a great day.
This was episode 4 of Kroll's ALTLOOK, the Alternative Investments Podcast. Thanks for tuning in, and remember to subscribe on Apple, Spotify, or wherever you get your podcasts. On the next episode, we will discuss how the SEC's new fair value rule will impact registered investment companies and, by implication, registered investment advisors.